everyone, Thomas Yao here at RDM Financial Group Hightower Advisors. Thank you for joining me as we progress through the summer. The markets continue to be positive this year, with the major indices in the mid to high single digits in year-to-date gains. Optimism picked up after stronger than expected earnings, progress on trade agreements with Japan and the EU, and continued enthusiasm for technology and infrastructure investment. It is noteworthy that even when companies report solid earnings, their stock price can still face volatility if management's forward guidance falls short of market expectations. Investors tend to price in not just current results, but also the outlook ahead. So any hint of uncertainty, particularly if alluding to slower growth or softer projections, can trigger a sell-off. And in the current market environment, the reactions have been stronger than in recent past. Even if there is some short-term volatility, we emphasize owning businesses that are leaders within their industries, deliver consistent cash flows and resilient earnings through a cycle, and are managed by experienced teams who practice discipline and thoughtfulness. Overall, mega-cap and large-cap companies continue to drive the positive performance, but not every part of the market moved in step. Utilities led the way, followed by technology, industrials, and energy. More defensive areas like healthcare and consumer staples lagged. Bonds were mixed. Treasury yields ticked higher, but corporate bonds held steady as credit spreads tightened. Overseas, international markets trailed the US, partly due to a stronger dollar. On the interest rate side, the Federal Reserve remains on pause. After cutting rates last year, they've now held steady for 5 straight meetings. Inflation progress has stalled near 3% on the core CPI, and the Fed is watching closely to see if tariffs add more price pressure. Rate cut expectations have been pushed back several times this year. Now all our eyes are on September, with odds of a cut climbing after a softer jobs report released at the end of July. Still, the Fed has been clear that policy decisions will be driven by the data. Speaking of the labor market, July's report showed just 73,000 new jobs, notably below expectations, and prior months were revised lower. Unemployment edged up to 4.2%, and long-term unemployment also increased. That said, weekly jobless claims, which give us a more current read, remain in a healthy range. For now, the data points to moderation, not a downturn. Tariffs remain a wild card. The administration's new structure, ranging from 10% to nearly 40%, is aimed at securing better trade terms and boosting domestic production. Some countries are already negotiating adjustments, suggesting these measures may be more about leverage than permanent barriers. Short term, tariffs could weigh on growth. Longer term, they may be paired with policies like targeted tax cuts or deregulation, which could offset some of the drag. Earnings season has underscored the staying power of certain tailwinds. Themes like artificial intelligence, data infrastructure, and power grid modernization are drawing substantial long-term investment. In fixed income, we are seeing an attractive opportunity. Long-term municipal bonds are yielding about the same as treasuries. That translates to attractive tax-free income. Semiconductors are another important area. Demand for advanced chips, especially those powering AI, is expected to grow more than 30% annually for the rest of the decade. The US is pushing to expand domestic production through the CHIPS Act, and we're seeing progress as new facilities break ground. Looking ahead, the economic picture is mixed. Manufacturing is still in contraction, and services are marginally expanding. Combine that with a softer labor market and a slow housing sector, and growth could ease in the months ahead. Trade policy, immigration, and global supply chains will be key drivers in painting the picture in the months ahead. Headlines and short-term news can move markets notably, but over time, fundamentals tend to drive results. Higher quality companies that are leaders in their industries and skilled managers have a track record of navigating challenges, adapting to change, and creating long-term value despite periods of volatility. Through it all, our approach remains: stay disciplined, focus on quality, diversify across durable themes, and be ready to adjust when conditions change. We continue to navigate the upcoming environment with perspective, patience, and a long-term view. Thank you for listening, and I look forward to speaking with you again soon.